Hi, it's been a long time since we talked, so I thought today we will cover mistakes, most common mistakes that investors make. Uh, Everybody wants to make money in the market, but we have to keep in mind to minimize the number of mistakes that we are making. As long as we can minimize the mistakes, we will end up making more money than the benchmarks are giving return. Some of the most common mistakes that I have seen over my years in wealth management is the first one is, of course, not knowing your risk profile. A lot of time, all of us want to make maximum return, but what we don't realize is the more return we want to make, it adds more risk in our portfolio. So, any new investor who is starting off investing, the first question that they should answer themselves is how comfortable will they be if their 100 rupee became 99, 95, or 90? That gives you an idea of the risk that you are willing to take. It's very easy to imagine 100 going to 110 or 115 or 120, but it becomes very difficult when that 100 becomes 95 or 90 or 85. So once you know your risk profile, that how comfortable you are with downside movement of the market, then your upside, although being limited, but at least will give you a peace of mind when returns are generated. Second most important mistake that I have seen a lot of investors make is panic selling. So we have seen over last 2 years, market has not given a lot of return. A lot of times, a lot of new investors or even seasoned investors, they end up selling at the worst possible time because they end up losing faith in the market or they let their emotions take over. This is a very poor mistake or very poor financial management. You have to keep one thing in mind. When markets are going down, it's very easy to get into the panic mode, but it's very difficult, however, very fruitful if you stay put to the plan. Once the markets have bottomed out, usually these investors who've exited, it is very difficult for them to re-enter the market and make the returns that they've lost because of the upward movement of the market. So whatever you do, please don't let your emotions drive your investment philosophy or your investment decisions. Whether it is downturn of the market or upturn of the market, lot of investors get into the market when market is giving very high return, thinking that they will also end up making very high returns. Both positive and negative, looking at the past performance of market and then investing is a very poor form of investing and might not yield the results that you want. The best way to manage your money, keep in mind, is always asset allocation. First, knowing your risk profile. Second, asset allocation and sticking to your long-term plan. That is why SIPs make most sense for new investors because they take care of the downturn of the market. You end up buying more units when the markets are low. And when the markets are high, you end up buying less unit, but at least the units you bought at low give you higher return. So you don't really have to time the market. You just have to stay invested in the market. As they say, timing nobody can do, nobody can time the market, but the time spent in market is what will yield the best results for you. Yeah, thank you.